Good afternoon, everyone. Welcome to today's webinar. Our topic today is, will REITs be a game changer for the Indian real estate industry as it is expected to be? Uh, we have with us Mr. Sanjay Bansal, the founder and managing director of Aurum Equity Partners. He'll be taking you through the rest of the webinar. We're just waiting for a few more people to join in, and then we'll be starting the webinar.
Good afternoon, everyone. This is Sanjay Bansal from Aurum Equity Partners. Welcome to the webinar on REITs, and thanks for joining in. I have with me my fellow panelists, Ms. Sita Khosla, Senior Partner at Dua and Associates, a leading legal firm in India, and my other panelist, Mr. Sunil Agarwal, Managing Director at Black Olive Ventures and a real estate expert in India. We put together this panel actually with the objective of trying to address most of the aspects relating to REITs in India, and also in an attempt to address questions which any of you may have in the course of this discussion. We have a presentation in front of us, which I'm sure is visible to all of you on your screens. We will run this presentation in the course of the next 1 hour. I think we'll run this for about 35 odd minutes, maybe 40. We will then throw this panel, this forum open for questions to all the people in the webinar. And raise your hand. There's an icon over there. Ask your question, and we will then address the question to the right panelist. We also have with us actually Mr. Sunil Malik. Sunil Malik is also a partner at Dua Associates and is a tax expert. So we again, like I mentioned, put together a panel with the objective to address all the various aspects of REITs and their relevance. I'm going to start with, as our topic says, will REITs be a game changer for the Indian real estate industry, right? Given the fact that it's much spoken about for the last, 8 years, maybe more, and now that we have the regulations and now we have the budget out of the way, we thought it may be appropriate to actually have this discussion and elicit a feedback from the various members of the people who joined the webinar. I'd like to bring my colleague Sunil in the picture. Sunil, would you like to give a backdrop about why has REIT become so very important in the Indian context, given that real estate has seen funding from so many places?
Good afternoon, everyone. I think, Sanjay, to answer your question, why REIT has become so important, is because Indian developers over the years have been developing commercial real estate. And if you look at the large ones, DLF, it could be Prestige, it could be RMZ, all these guys have always had one problem while their PE funders have asked them, what is the exit? And whenever that question has been asked, I think there have been, very, answers have not been found easily because typically commercial real estate has been offloaded to high net worth individuals. And that is not going to be the way forward simply because the ticket size for these deals have become very, very large. So I think REITs, as is understood globally, provides that monetization to developers, large commercial real estate developers, and obviously that definition can be extended to a lot of other asset classes. In the absence of such a regulation, a lot of developers, and some of them have actually gone and listed in Singapore Stock Exchange, and therefore these alternate platforms to seek an exit typically don't exist in the Indian context. Now that we have a regulation, I think that possibility exists. I think the second reason why REITs have also been important and are going to be important is that there are a lot of pension funds who need stable income over a large period of time, which is possible in global markets. In Indian context, such an investment opportunity is not there. And there has been a significant desire from a lot of institutional investors to invest in an asset class and in an instrument that provides a stable income over a period of time. So I think given those two very large, so there is a buyer of those REIT assets and also there is a seller, it should at least become a very important play for the largest players in this market.
We've had the regulations for FDI for the last 10 years, and we've seen a lot of private equity in real estate in the last 10 years. Actually, exactly in 2005, government came up with the first FDI regulations on real estate. And also, we have seen that other than private equity, a lot of developers actually went and listed for the first time in the capital markets in India, following those regulations. Isn't there enough money which is coming through private equity route or direct capital market raising, and therefore why are REITs a breath of fresh air given the various other avenues of fundraising?
I think just to bring back 2005, 6, 7 days, a lot of people used to question as to what is it that the PE fund can give. And I think the debate was, are you just another expensive money source? And the question as to why PEs were even successful in investing in the Indian context was because the funding in typical Indian context is required for buying land. And so whether it is PE deals or if you see even large IPOs, whatever cash has been released by these entities has been used by developers to buy more land. In the case of REITs, again, I think the driver is going to be very similar. The only thing is that in a commercial asset, it is not a self-liquidating asset unless you are doing small format offices where you do an office building which can be liquidated over a period of time. I think you are going to require significant amount of pools of capital who will buy into an established or a stabilized asset. And I think REITs therefore are a fresh air because while they provide capital for a developer to put in, again, back in land in the business, it is an exit for him of an asset. The rest of the debt were more for construction, finance, or for execution. So, in this context, I think REITs serve a dual purpose. A, they're giving you an exit from already a stabilized asset, and two, the money that you realize over a period of time can be used by the developer effectively in buying land and therefore creating more such developments.
People in India have often compared in a layman's sense, REITs to the rental discounting. and we all know that yield-bearing assets or LRDs have been prevalent in the market for a very long time in India. Now it is taking a more formal shape in the form of REITs. For the benefit of the audience, would you like to draw a comparison between these two avenues? Because this has been a serious source of money for the market in real estate.
Sanjay, rental discounting, it's a mechanism which is used by developers to raise money. And there are several benefits of it. I think there is this whole concept of a developer who says, I do not want to develop at times, I just want to sit idle because the market conditions are not allowing me to do so. Now that flexibility LRD offers, that there is an asset which the developer has, he can tap into that asset as in on a need basis. And then obviously, smaller developers would also want to argue that they have already an exit mechanism when their asset can be sold off to high net worth individuals piece by piece, floor by floor, and that is going to give them a lot better liquidity. Also remember, I think for the audience also, there is a parallel economy in this country, and the true realization of the value, if you look at REITs, only when there is a large ticket, then only the people are more inclined to go to a REIT. Otherwise, such smallish kind of transactions can happen outside the system as well. So while lease rental discounting remains and will remain, in my opinion, a darling for the smaller developers, it has several restrictions. I think banks over a period of time have reduced, have increased the so-called, the security they want to cover, they want to take on a particular asset. So if the asset cover was about 1.5x, it has now grown to 2, 2.5, even 3x. Also, I think typically the amount of time that you have available to repay the loan is limited. It's about 12 years. Versus REITs, which give you complete, freedom to use the money, and there is no such time restriction. There is no time, cost of money. Again, the argument is which size of a fish you are. You are a bigger fish, you can keep the money, you can keep investing it wisely and make returns. For a smaller developer, his effective rate of borrowing becomes the rate of the bank minus the maximum marginal tax rate, because he feels that the moment I take a loan and then I service the loan, I am also getting an amortizing benefit of it. So I think the debate is whether LRD is a good product. Yes, it's a great product. It's for great product for those who will probably not have the scale and size. But for the developers, which are the largest developers, I think REITs are a solution, because that is the only mechanism which will give them 100% exit and will give them the right values and the ticket sizes. That is an institutional mechanism that gives you benefit over a long term.
So really, what if you were to really assess and say, okay, now we have regulations, but really what is the potential of REITs in terms of square feet and category? What is your assessment of the potential market for REITs in India?
To be honest, I mean, leasing, if you look at any report, whether it is CBRE, Cushman, JLL, all the top, the biggest brokers, if I were to say, for leasing in India, there has been a consistent uptake of office space between 25 to 30 million square feet across the good and the bad times. And when I say this, you would have a situation where you would have in every 3 or 4 years at least 100 to 120 million square feet of space which has been leased in this country. Now, given a track record of the last 10 years, if you look at that 10-year scenario, there has been years where the leasing has gone up. In some years, the leasing uptake may have been slower, but an estimated 376 million square feet of Grade A office space has been leased out. And this is not taking into account Grade B spaces, and therefore this is prime office IT locations, out of which, when one looks at what is estimated, is that a third of it is at least what is REITable. And why 2/3 is not REITable? Because it may be too small a format, or it may have been sold in pieces and chunks to the other HNIs. So given the fact that there is 100 million square feet of REITable space, and that this market will keep on increasing by a similar amount over the next 3-4 years, you at least have about 7 to 8 largest developers who would be willing to sort of REIT out their space, and the size could be anywhere between a $10 billion to a high of $20 billion, depending on the value of the real estate. Also, one must not forget that there are a number of corporations, for example, HLL, Procter and Gamble, and even Air India announced recently, may not be a great example, but there are a number of these corporate bodies who hold large amount of real estate. A lot of banks significantly are known to LIC itself. They have very, very large real estate holdings, and when you look at this holding, the size could be even more. And most of these corporations will go into a sale and leaseback mode, especially the ones who will probably suffer a little bit of a liquidity crunch. This would probably be the easiest way to unlock their balance sheets, put the money into more productive use. And even those, I believe, are lower hanging fruit when it comes to REITs. So even some of that space is going to hit the market. So, if you look at really what is the potential, I think the REIT market is equal to what India has received as an investment size today. So if India has an estimate between 10 and $15 billion, depending on which data you're looking at, I'm reasonably confident that the market that you're sitting on in REITs is similar to that market. And that market, may not be opened up in exactly tomorrow, but I think give it a couple of years, maybe 3-4 years, this market is going to be of a similar size at least India. And if you look at the presentation also, I think there's an incremental growth. If you see in the chart from 2007 to 2013, the lowest office intake has been 21 million square feet. And if you look at the high, it was about 37 million square feet in 2011, which is post, all the recession. So while there's a dip in the vacancy in 2011, you can see high vacancy in 2009, which means that there may be a lag for office space or other spaces to have been absorbed over a period of time, but certainly that absorption has happened. So given the market size, I think you could look at potentially at least a 10 to $20 billion space right now, and that market should increase every 3-4 years of equivalent by $7 billion.
Thanks, Sunil. That brings us to the next important part of this discussion, which is what really a REIT looks like and what is the typical structure of a REIT under the regulations, under common understanding for the benefit of the participants at the webinar. So could you carry us through a typical structure of the contemplated REIT under the guidelines and how this will pan out for any developer or asset owner in India?
Well, Sanjay, I think if you look at the REIT structure in itself is a fairly simple structure, and I don't think so there is any difference in this structure versus a typical PE structure, barring one difference, that the sponsor in the case of REIT has to be a larger sponsor who's possibly going to be a developer or a person who's got real estate under its balance sheet. So typically you have a REIT which is registered as a trust. You have unit holders who would invest in this REIT, and this REIT is always, as per the regulations, a listed entity. So you would have a sponsor typically who would put the assets that he holds under an SPV, entire 100% of his assets, or sell those assets to a REIT, and the REIT would then be a listed entity which will have its units which will be given to shareholders. Apart from these two, there are two other entities which are significant. One is the trustee, and trustee really has the function of distribution of REIT's income and seeing through it that the corporate governance standards are met. And REIT manager, which in this case, the regulator has said REIT manager essentially will perform the same function as that of an asset manager. And this REIT manager will decide which properties to invest into, which properties to exit out of, what kind of agencies to employ, so that the REIT assets are taken care of in a significantly good and for the interest of the unit holders. So that is the structure that governs a REIT. Typically, a REIT would either buy assets directly, or it would invest into an SPV which holds the asset. Now, the regulation says that this SPV must have 90% of the asset that it is holding. That control has to be about 90%. So there is this whole structure within which the REIT can either buy a physical asset or can invest into an SPV, and then subsequently this will have tenants, and that's how the REIT is planned.
Maybe it's at this point in time I want to bring my other panelists into the discussion. I'm going to request Sita along with Sunil Malik to walk us through this restructure with specific references to the regulations, how they are, the tax issues, the responsibilities. Sita, over to you for a little more incisive conversation on how does somebody go about creating such a structure, and what are the various nuances in the regulations in terms of REITable assets, the responsibility of the various people involved, and not to mention the tax issues in making a REIT effective and commercially viable.
Thanks, Sanjay. So the REIT has to be set up as a trust, and this requires to be registered with SEBI. It is for the sponsor to effect the registration, and the sponsor has certain eligibility criteria. Basically, there has to be there could be up to 3 sponsors. A sponsor must hold at least once the sponsor transfers his property into the REIT. It is only then that the property in the REIT units can be listed. The sponsor would continue to be having some skin in the game. So it's important that the sponsor stays engaged in the whole process. Other than the sponsor, we have trustees. The trustees would be responsible for ensuring compliance with of the various stakeholders, and so that the interests of the unit holders are protected. We also have the manager who would be responsible for recommending and identifying investment opportunities and complying with the investment conditions and strategies. So effectively, this is a much more regulated process than we have had before. And Sunil, I'd just like to bring you in at this stage to perhaps take us through the structure and also the tax implications.
Yeah, hi, this is Sunil Malik. See, the way the REIT regime is getting structured through the regulations, the way the REIT structure is getting structured through the regulations is that the sponsor will transfer its SPV, that is special purpose vehicle, but holds the REITable asset into the REIT. At the point of this transfer, there may be a requirement for the purposes of valuing the particular asset. The issue here which is likely to arise is the transfer of the asset from the shares of the SPV to the REIT. Will it be a taxable event or not? It will be a taxable event. It will be a taxable event, but the Income Tax Act provisions have been made whereby the sponsor will not pay any tax on the transfer of this particular SPV to the REIT. The particular exemption has been provided under Section 10 of the Income Tax Act, so that this is not a transfer, and also there is no income which is subjected to tax. But the units which are to be issued to the sponsor, those sponsor units will have to be held by the sponsor for some time before he is able to sell it off. Once he sells this off, earlier the regime was that sponsor units were not being given the benefit of security transaction tax payment, so that it could be exempted from tax. Now, under the Finance Bill 2050, the regime has been recommended to be changed, so that sponsor also does not pay tax on the alienation of these units to the stock exchange, and he pays the security transaction tax. Once the asset is available within the REIT, which is the SPV, then SPV actually is realizing the income, rental income. So once it realizes the rental income, it pays tax. It pays tax only on the basis of the net income what it finally is able to achieve. Basically, after the operating expenses etc. have been reduced, the money what the money what is available with the company in terms of the profits of the SPV, the taxes will have to be paid by the SPV, and whenever the SPV transfers money to as a dividend to the REIT, it will again have to pay the dividend distribution tax. Once the dividend distribution tax has been paid, the money reaches REIT, and then REIT can distribute is required to distribute into the regulations 90% of the income. So it has to distribute it to the unit holders. Since there is a complete pass-through for this, there is no amount of tax which is required to be withheld, and the income is exempt in the hands of the REIT holders. One more thing has been done in the present budget is that if the real estate investment trust is holding the property directly, then the pass-through has also been provided for the rental income. Rental income, when it is received by the real estate investment trust, there is no requirement on the tenant to withhold tax, because this rental income is not supposed to be taxed in the hands of the REIT. So once it is not taxed, then when this income is to be distributed to the unit holders, it will have the same character, and the REIT will have to make tax withholding on if the unit holder is a resident person, then 10% withholding tax has to be there, and if it is a non-resident person, then the tax will have to be deducted at the rates in force applicable to the person concerned. It is possible for real estate investment trust to actually raise borrowings and then give it to the SPV. So once it does so, there is a pass-through for interest is also provided, in the sense that the real estate investment trust, when it receives the interest from SPV, there will not be any tax which will be deducted by SPV, and also it will not be taxed in the hands of the REIT, but it will go direct to the unit holders and will be appropriately, the tax will be withheld appropriately by the REIT.
So Sunil, if I was to ask you in a very simplistic, way, is our REITs today efficient from a tax perspective, right? That means are they tax friendly? What's your answer to that question?
I think more or less from the perspective of.
Let me break it into two parts. Sorry, from a capital gain standpoint, are REITs an attractive area?
If you look at it, the sponsor, when he is transferring his asset to the SPV, it is not supposed to be taxed in his hands. So that means there is no capital gains tax which is going to be there in his hands. So that way there is enough comfort has been provided to the sponsor.
If you look from the point of view of the REIT unit holders and the income they receive, right, is it efficient for them in terms of the taxability of them for holding units of REITs?
See, there could be two kinds of the revenue streams in the hands of the unit holder. One could be in the terms of dividend, which is for which there is no tax which is to be paid, because dividend is received through the SPV structure and dividend distribution tax has been paid on that. So that way it is tax neutral to that extent. There is no further tax to be paid by the unit holder. In relation to the interest what is distributed to it, or income what is distributed to it, naturally he has to pay a tax on the basis of whatever his income levels are, and he has to pay tax on that. And also, whenever he offloads his units on the stock exchange and pays security transaction tax, there is no capital gains tax which he will have to pay.
Okay. Has the current Indian fiscal budget 2015 provided all the needed benefits or changes to the REIT regime to make them commercially viable and doable from an Indian standpoint?
Kinds of issues what are likely to be faced is one, that when sponsor is actually not transferring the SPV, but if it wishes to transfer the readable asset. So at that point in time, there are stamp duty issues which are not yet been addressed, because the stamp duty will be required to be paid by the sponsor for transferring the readable asset. This is one issue which has not been addressed, though stamp duty is a state subject, but nonetheless the government should come into play and have some kind of transitional benefits available so that REIT can actually start. Second issue which is likely to be there is the payment of the minimum alternate tax. Whenever sponsor is transferring its readable asset or SPV into the REIT, that point in time there is a possibility of the capital gains tax being available. Now, because of the regime what has been put in place, if the shares of the SPV are getting transferred to REIT and units are getting allotted, the capital gains tax is not payable. However, in the books, capital gains may still appear. That is profit on the alienation of shares of the SPV in lieu of the mutual fund or the units of the REIT. There may be a profit element which will be available. So there may be an incidence of, or there may be a requirement to pay minimum alternate tax there. So government should do something on that front, because MAT otherwise is a cash outflow. Even though it is not a state write-off, but fact is that it is the immediate payment which the company will have to pay.
So you're saying part of the various issues outstanding, two key items, one being stamp duty, second being MAT, which still continue to be open issues even after the fiscal budget 2015.
Yeah, because there has been no proposal on that account. I think that is likely to be there. And in relation to MAT, the government is clear that they are getting good amount of revenue, and so they are not likely to.
So I guess in the current context, we have to live with the environment, with the regulations, and look at the commercial viability of REITs with the regulations as they stand today.
That is right.
Sunil Agarwal, if I was to bring you into this discussion and really ask you specifically, what really constitutes REITable assets under the regulations?
I think any asset which is income producing is REITable by definition. But if you really look at the guideline, minimum 80% of the value of REIT assets shall be invested in completed and rent generating properties, which means that the property must be already constructed and it must be rent yielding. Now there is no definition how much of that building should be leased. I mean, it could be 10% or 20%. It could still be a vacant building and only sparsely occupied and could still form a REITable asset. I think the intent really is more important here, and I think the intent is that you cannot invest in a building which is under construction, and if you were to invest in that building, you can only do it with the balance 20% of the fund corpus. So you may have a situation where a REIT will invest in a building which may not be yielding anything, which will be under development, and there is also for the purpose of investment, you can invest in mortgage-backed securities. Now, if they do exist in this market, you can probably go and buy those things. But largely, I think if you look at for the listing purpose, a minimum combined value of 5 billion, which is 500 crores, and minimum thereafter a size of 2.5 billion, 250 crores, or 25% outstanding units. So basically, that's like more of an eligibility criteria as to what kind of properties can be listed. So if you have an asset which is, or set of assets which is less than 500 crores, then your listing will become difficult or it's not allowed. So you will have to have a minimum size of 500 crores. So smaller properties, I think if there are owners, they'll have to really get and combine themselves to sort of do the listing. And up to 3 sponsors is what is allowed. So you cannot have more than even 3 people who can combine their properties and do the listing. In fact, incidentally, my own belief is that REITable assets in this country are going to grow once the REITs are going to come in, because they're going to set a benchmark as to what kind of returns one can expect from these. To quote a very, very interesting example, Sanjay, I was in the US last month, in fact most of this as well. There's a very interesting development even in a mature market like US, where there is a developer called Forest City, and Forest City classically was into a lot of commercial development. They also were doing a lot of residential developments, but they at some stage have decided themselves to become a REIT. And what I think was driving them towards becoming a REIT was the fact that if they developed commercial assets, they would find it difficult to sort of get the full profit out of those, because somebody would bargain them cheap on the REITs. The other is that even if in the residential developments, they would have to develop these malls and office buildings, which would then increase the value of the neighborhood, and then they would be able to sell these residential assets. So what they're basically saying is that development had become a very cumbersome game. So what they did was they outsourced the development to a shortlisted 7-8 sub-developers, and whatever commercial assets they kind of develop, they've converted themselves into a REIT, so that they kind of buy and sell these assets, or at least have a ready capital to buy the assets that they are developing. Now that is becoming a very interesting model, and if you look at the Indian context today, you have two potentially largest REITs that are in formation. One is obviously the Blackstone Embassy deal, and part of that deal, if you look at, initially the assets were only stabilized assets, but then the fund Blackstone went ahead and also acquired an unfinished asset, which was Vrindavan Technology Park. Now, why that was done was surprising, and when you look at this kind of example of Forest City, it is not that surprising anymore, because the developer, what he's saying is that I will have a ready cash available to buy my own assets at a pricing which is market dependent, but at least that profit realization will come to him, and that too probably for in the current laws without any capital gains. And so you're having a set of developers who will develop and will sell back to the REIT that they form. Again, if you look at the Peninsula Group transaction that happened, Brookfield came into this country first in partnership, and now what they did was they acquired Unitech's assets in UK. If you look at the typical Unitech SEZ parks, there is 12 or 10 million square feet which is developed and leased. There is another balance 50%, which is another 10-12 million square feet, which still has to be developed and leased out. And over a period of time, I think the game plan of that REIT, as and when it lists, is that they will also develop these 10-12 million square feet of space and put back into this REIT. And therefore, the multiple, is going to be substantial from the perspective of the developer. And it remains to be seen, what other asset classes play out in this game.
Thanks, Sunil. Obviously, in the Indian context, US being the largest REIT market in the world, with hundreds of billions of dollars worth of REITable assets and REITs actually in market cap terminology, we are still learning, and I think we'll be learning fast, and there will be situations, hopefully in the near future, where many more forest cities could be built and created as REITs in India. If I now move on, ladies and gentlemen, to how this whole ecosystem is working, and I'm going to take this up myself. Essentially, we have multiple parties involved in the whole REIT ecosystem. As explained to you earlier by my fellow panelists, the sponsor is the key player in this entire thing. The sponsor is the developer, the asset owner, and really the person who's creating the REIT. The REIT manager, in turn, is the professional or the firm who is backing the creation, the operation, the management of the whole REIT. The law has very clearly defined the responsibilities, the roles, the eligibility of a sponsor, of a REIT manager, and a trustee. Along with this, there are certain other people who become relevant for making a REIT happen and for continuous operation and for continuous management of REIT. they have different role plays. So you have an auditor, you have a principal valuer, you have lawyers, you have merchant banker, you have tax consultant. Why do we put all these categories over here? I think first time when you do a REIT, a lot of these professionals have a role to play. A tax consultant from the point of view of making sure that the relevant tax inputs are there for creating a REIT, a merchant banker for the whole listing process of a REIT, a valuer under the Act for ensuring that the REITs are valued on a regular basis for the benefit of unit holders. The lawyers would play a role of actually the REIT structure, creating a REIT structure, and the auditor, of course, from vetting the accounts of the REIT, the trustee being the repository of all the benefits which accrue to the REIT unit holders. There are multiple parties involved in the REIT ecosystem, both at the creation, at the formative stage, and at the operations stage on a continuous basis, and these together constitute what I'm calling the REIT ecosystem. Needless to mention, we've yet not seen the first REIT ecosystem, and but we are finding a lot of conversation and discussion which has started now, right, amongst various members of the REIT ecosystem with key sponsors to be able to create REITs in India. Like I mentioned, there are criteria over there. We have defined who can do this, various roles very clearly in the law. Nothing specific to highlight in this discussion, but take it that the criteria have been so well defined that it will ensure that the right people are involved in the creation as stakeholders for the REITs. With this, I will throw open the discussion to panelists and to the audience on Q&A. So feel free to raise your hand, ask a question. We will address the question to the right panel members and try to attempt to answer your questions. We've already received a bunch of questions from some of you in the registration process. Maybe I can start with some of those questions, and in the interim, should you have any questions, please post them on the screens. The first question we have is, do Indian developers have enough incentive to look at REITs as a serious option for fundraising? Which are the key developers expected to benefit the most? So I repeat, first question is there enough incentive in the REIT regulation for fundraising as an option to developers? And who are the developers who benefit the most? Sunil, would you like to address this?
Yeah, Sanjay, I think when you look at the developers, and I'll come to that first, who are keen to sort of do a REIT in what the market gateway says, I think the top two contenders we've discussed, which is the Blackstone and MSC. I think they would form the largest REIT in the country in the years to come. I think this year we're already in the process of getting the documents ready. Obviously, Peninsula Brookfield being the next largest REIT. There are a couple of ones that are lined up. DLF, again, they're having problems with their own account, but I think at some stage will come back with a large REIT. Prestige, again, has a lot of commercial assets. RNG, Panchsheel in Pune. So you have about 6, 7 of these very large names which we've they're doing rounds in the market for a REIT to happen. Do developers have enough incentives at this point in time? I think the incentives and compulsions both exist. I think one is that there is this market which is not giving funding to a lot of people, and you will have some of these assets come into the market only because there are liquidity issues with a lot of developers. Two, is there incentive? I think currently incentive is not that great because I think there is one issue that Subin Malik discussed, saying that once the developer goes to the market with a REIT offering, he will have to pay a MAT or a large stamp duty. So that's a big deterrent. The other is that today the bank interest rates are fairly at about 8% levels, and some of these mutual funds are offering returns which could be post-tax 9%ish. And now, given that kind of a scenario, I think there is this little bit of an inhibition in the mind of a lot of people that will reach at 8% returns, which is what most of the developers would try and sell their assets off. And if you look at the last couple of transactions, they have been between 8 and 8.5%. Will be attractive enough for an investor. But surely, the larger the developer, the larger the commercial assets under his belt, REITs is definitely an incentive because the ultimate objective of developers is to be able to exit out of a developer and then do the same development and make your development margins. No developer is doing this business of development for that 8 or 9 or 10% return. So that I think is incentive enough for a lot of developers to go into REITs and to sort of sell their assets.
My next question is, which we received is, are there sufficient REITable assets available with Indian developers? You may have partly addressed it, but would you like to address it?
I think there are a lot of REITable assets. While we were in the presentation, our estimate is about 100 million square feet of space, which is all REITable. Also, I think the question is again, who are the largest players there? And I think all those largest players between them would have a significant amount of share of that, about 100 million. So I dare say that while you look at REITable assets, and if there is a fund or there is some kind of a asset manager who's trying to become a REIT by going to 5 or 6 of these developers and trying to buy their assets to become a REIT, I'm sure that kind of a play is definitely restrictive because all the big boys are not going to sell to that particular investor. And so from that perspective, if it's from a purely fund-driven perspective, I think there's a paucity of assets which are REITable. But from the fact that are there enough REITable assets, yes they are, and I think the lead will be taken up by either those corporates with large amounts of real estate with them, or it will be the developers who hold a large amount of commercial assets. So investors alone, just disappointment. But if it is a developer or an entity that is already developing, commercial assets, that will be definitely there. Next question, Sanjay.
There's a question from Ankur Kejriwal. The question says, please explain the basic objective of forming a REIT and what it actually I'll repeat the question again.
What it is actually.
And what it is actually. Can I pass this to Sita? Basic objective of forming a REIT and what is actually. I think essentially the gentleman is asking about the legal structure on the REIT.
So the REIT is constituted as a trust, and the trust is managed by the trustee. The objective is to have an entity which will then issue units to unit holders. These unit holders will be the sponsor as well as the public. So there will be retail investors in the REIT as well as the sponsor who will be continued to invest in the REIT with a minimum holding of 15%, and unless of course he sells to another sponsor. You could have, as we said before, more than one sponsor, up to 3 sponsors with a minimum holding of 5% each. But effectively the sponsor stays invested and engaged throughout the process of throughout the life of the REIT.
Thanks, Sita. There's a question from Vivek Soy which says, can a manager and sponsor be the same entity? If yes, will it lead to a conflict? So the answer is, I think technically it can, right? A lot of conversations we had where the sponsor wanted to control actually the REIT, but frankly, I think it's counterintuitive because it definitely is a conflict. The role of the manager and the sponsor is clear and defined, and while the sponsor is the asset owner and wants to see the asset grow and get valued properly, the actual mechanism of ensuring that everything is hunky-dory is left with the REIT manager. My own view is that if it's the same entity, then the conflict is serious and therefore not in the best interest of the REIT holders. There's a question from Karan Nankani, which is, what is the role of principal advisors? I'm going to take it up. As I mentioned at the end of the previous discussion, that there are various members of the REIT ecosystem, fundamentally sponsor, manager, trustee, and then the various people who will help in the creation as well as the regular management of the REIT from a financial perspective. The principal advisor is a fictitious entity. It is more in the form of ensuring that there's a coordinated effort, and therefore there is no officially defined principal advisor in the REIT regulations. The next question from Amit Jain: is there any possibility to start a REIT by a startup reality company?
I'm going to take that up. Amit, I think the startup reality company has a lot of funds and it has bought a lot of assets, then only it is possible. Otherwise, if you are saying that a REIT can be done by somebody who doesn't have capital, REITable assets under its belt, it is next to impossible. It is impossible in the current regulations. So also there is this whole regulation that says that the sponsor of the fund must have a minimum 5 years of real estate development or fund management experience in real estate. So even the regulation says that there is no possibility of a startup to get into this, and if sponsor is a developer, then there is a track record of at least 2 successfully completed projects. So I'm afraid this is not a play for startups to get into.
So this is something I'd like to add to this, Sunil. When you're talking about experience, group experience would count. So you could rely on group experience, experience of group companies to satisfy that eligibility criteria.
So which means that you can have a startup company and you can have the sponsor of the startup company, if I have to say, have that experience and that may qualify. But it will have to have REITable assets, which means that the startup company is going to have a lot of capital, at least 500 crores.
Next question from Hemant Suri: are there enough different RE asset classes in the country to support REITs, or are we going to see all the REITs chasing the same properties, driving up prices? Sunil?
I think, Hemant, there are a lot of asset classes, but the biggest demand will come from the investors, and I think the investors currently look at REITs more from the perspective of office spaces. I think India will have assets over a period of time which will be diversified into hotels or parking lots or schools or hospitals or warehouses of such kind. But the prime requirement is definitely of the office, and for some time I think those are the assets that REITs will chase. Well, will they chase the same assets? Yes. In the Indian context, it is always a seller's market where at times if you have a prime asset, it is chased by a lot of people. Again, we've seen deals fall through even when the asset is well known and it is being chased by a lot of people. So I think really it will depend on the appetite, the objective of the investment manager. And the trophy assets are always going to be expensive. There are going to be others that are not going to be so expensive. So let me give you an example. It is not uncommon in the international context to sort of find REITs chasing properties which are down and out. And when I say down and out, these could be city center properties which have been dilapidated, and somebody finds a value in that property, refurbishes, redoes that property, and repositions the REIT and makes a killing out of the fact that you redeveloped the property. And the latest example is the Empire State Building, where the REIT is almost gone to twice its value because they put up a gym and a lot of retail activities in that building.
And what cap rate, what is the cap rate at which REITs are likely to be listed? Ashish Gupta asked this question.
I think, Ashish, the cap rates are 6% or 5% if a developer has his way. If an investor like me has his way, it is about 12%. So I will take the average. Probably the first listing will be at about 8 or 9%. My guess may not be very attractive to retail investors, but I think expecting a listing more than 9% of a trophy or a good asset at this point in time seems to be difficult because people are dragging their feet, and they will look at the interest rates in the market go down a little more before such assets are going to hit the market. So I think my best guess in this case is about 9%.
I also would add that if you look at a lot of smaller private transactions where HLWs or corporates buy leased assets, we often see them happening somewhere in the 8 to 9% range at an average across the country. So that will be some kind of reference point, although the verdict is out on this. Karan asks, what kind of employment will it generate? Maybe I'll just talk about it for a minute. We all know that real estate is a very large employer. We know the construction industry plays a key role in employment. So I think it's a direct function of how much impetus will the REITs do in terms of funding for revitalization growth of real estate. So if that was to happen, it will generate more employment. It's more a funding mechanism. I don't expect many REITs and therefore many employees in these REITs, right? I think each REIT will be like a private equity firm or the like, a tightly managed entity. I don't expect REITs standalone to generate a lot of employment.
Can I just add to this, Sanjay? I think there is already enough employment generated by a lot of buildings that are managed by facilities management firms. And I think if you look at the employment generation, yes, I mean, people looking at facilities management as a career or asset management as a career, as they say, so there will be some expansion on that side of the career because you will need more skilled professionals to run REIT real estate versus anything which is non-REIT. So I think just an expansion of one subcategory.
We have many more questions and lesser time. I'm going to address questions from people who have not raised them yet. Vikas Bansal asks, will units issued by REITs of perpetual nature or fixed maturity, in case of perpetual nature, there would be a risk related to rental yield, etc. Sunil?
I think one is that REITs are always in perpetuity. So when you are listing a firm, you don't expect the firm to go down and the building to collapse the next day, even if it was so there is an asset class. So I think the REIT units will be in perpetuity. Will they have risk of rental yields falling or going up? Absolutely. And you do have downtowns which have lost a lot of value in the worst of the market, and the markets have come back and people have made so this is like playing a stock market. I think in the Indian context, the supply of commercial real estate is very large in some sections. So if you have to be investing in IT space in the fringes of the cities, yes, this whole thing can be very volatile. If it is primer asset, city center, probably the volatility is going to be a little less. But obviously those vagaries of rental yield, etc., and that is where I think the market will be mature enough to realize that real estate doesn't go all the way up always in one graph. It will come down, it will go up, and I think that is where the market will mature.
So just to add to that, Sunil, from the perspective of the unit holder, there is the benefit that is required under law to be a 90% distribution.
Correct.
So it's not that you can deploy that revenue towards some other end.
Correct.
That at least
Hedges it to
a certain extent.
Yeah.
A question from Chirag Gupta, which says, apart from MAT issue, are there any other issues that the sponsors are looking at from the government and tax authorities for solutions? Sunil, any?
Stamp duty.
I think the big one.
Yeah, stamp duty is the other big one, because at the stage of transfer of an asset to the REIT itself, if we do get some stamp duty emissions or other benefits, that will definitely help the REIT market to take off.
I'll take up two last questions. The question from Mandeep Lamba. Do we have clarity on hospitality REITs? How will hotels create rent or annuity income without seriously change in the structure of their operations? So, well, the answer is yes, we have clarity. As per the definition and law, it provides for hospitality REITs will happen. Having said that, I think the question is saying, since you charge a hotel on a daily basis, how will REITs therefore get created? I think you will have you will create REITs by splitting operating assets from lease. The lease income will form part of regular REITs. The operating or the daily income will therefore be the upside, which can be attached to a REIT. So at a recent conference on hospitality, I did speak about it, and there are mechanisms which can be evolved to actually address the fact that hotels have daily income as opposed to lease income, rental income. But you could restructure the hotels into lease and operating assets, and therefore create applicability of REITs. Very last question. What Ashish Gupta asks, Ajay Sharma asks, can developers who have already sold their assets but hold certain shareholding in a REITable asset go ahead and only list their shareholding in a REIT? Can such aggregates be listed as REITs?
I think yes, you can do it so long the 100% of what you hold is given into a REIT.
And you have to have a controlling interest.
And you have to have a controlling interest. So that is what it is. At no stage can you sell more than 50% or 80% of that holding, and then you are balance 20 and then figure in. You have to have demonstrated control over the asset, and that is what you can do.
I want to take one last question, Ashish Gupta. What are the returns that individual investors can expect from listed REITs?
I think anybody's guess you're going to hear stories where this is again going to go to 15-20%, because I think there is a part of offerings which are saying that you will get a regular 8 or 9, but since the capital values are going to appreciate, therefore you are going to get into high teens or mid teens at least. The other side of the story is that you are going to have an 8-9% yielding asset which is going to marginally only grow, because the rents cannot just keep on growing at even 15% every 3 years, and therefore the post-tax returns are going to be around 6-6.5%. I think there is a large gap between 6.5 and 15, and really it will be the offering, the nature of the REIT manager and everybody and everything associated with it. So it's going to be as complex as reading mutual funds today, and I'm sure that is what is going to add the spice of these. But I think the expected return from an investor's perspective is going to be at least 100 basis points above the bank rate that you will get for 4 or 5 years of investing. That is what will be the expectation of the investor on the street. But typically, if you look at international markets, REITs have generated better returns than 4 or 5 or 6 years of investing into a bank, FDR, or instrument of that nature.
Thank you, Sunil. With this, I want to thank all the members, all the attendees of the webinar. I want to thank Ms. Sita Costa from Doha, Mr. Sunil Malik from Doha Associates, Mr. Sunil Agarwal from Black Olive, and all the attendees for participating in our Aurum CXO Dialogues. We will be sending out presentations to all the members registered for the webinar for your consumption in the course of the week, and we will try and address any questions. If you have any further questions, feel free to write to us, and we will get in touch with the panelists and make sure they are addressed in the course of the next few days. Thank you very much once again for joining in, and look forward to interacting with you in the future on yet another new series on the Aurum Deal Curry CXO Dialogues. Thank you.